Okay, now we are starting from here. QR has budgeted to produce 4,000 units in January. Actual production units was 3,700 units with the fixed production overheads of 10,300. Standard time or standard fixed overheads per cost per unit is 1.5 hours at a rate of $2.4 per hour. 5,800 production hours, actual production hours were worked. Fixed overheads volume variance. Volume variance deals with budgeted production units minus actual production units. Now actual production units are 3,800 multiplied with overhead absorption rate per unit. Overhead absorption rate per unit is not available, but we can calculate OAR per unit is equal to 1.5 into 2.4. So we have what? 1.5 into 2.4, 3.6 as an overhead absorption rate per unit. 4,000 were budgeted units. Actual units are 3,700. It is multiplied by 3.6. So we have $1,080 as variance. Now actual production units are less than the budgeted production units. It means we paid fixed cost for the 4,000 units, but we actually produced 3,700 units. So we wasted the fixed overheads for 300 units. So it is an adverse variance by $1,080. Which of the following could be the cause of an adverse sales volume variance for garden furniture? Company offers discount to sale price in order to maintain business. Discount will lead to increase in sales. That's why variance could be favorable rather than adverse. Poor weather leads to a reduction in sales if it is relevant with the weather. A strike in factory causes a shortage of finished goods. If there will be a shortage of finished good, it means you will be unable to sell more units in comparison with the demand. That's why there, or in comparison with the budget. That's why there could be an adverse sales volume variance. So the correct option could be second and third, but not the first one. Then we have what is the material usage variance. The information relates to April production of the product CK. Units produced 580 as actual, 600 as budget, 15,300 as budgeted input, and the user price is 76,500 in total. Requirement is material usage budget to calculate, or sorry, material usage variance. To calculate material usage variance, we need total standard usage, and we will calculate standard usage per unit. 1,500 divided by 600, it's 2.5. So 2.5 is standard usage per unit multiplied with actual production units. It is 1450 minus actual input 1566 into standard price per kg. Standard price per kg is 77,517 divided by 1566. 77,517 divided by 1566. Sorry, standard price is needed. I am using the actual data. Standard or budgeted means what? 76,500 divided by input budgeted 1,500. So you can calculate your budgeted price per kg 51. So $51 is multiplied here. Standard usage is 1450. Actual is 1566, which is greater than the targeted or standard. So we have 5916 as adverse variance because we are consuming more material in comparison with the targeted or budgeted. Any question? Material purchases variance. Okay. In fact, he is not asking for the material purchases variance. In fact, we will use a formula: material usage plus closing stock of raw material minus opening stock of raw material. If material usage is not provided, then budgeted usage per unit into actual production units. So now we have standard material usage of 3, which means budgeted, into we have actual production units of 500. So material usage is 1500 plus closing raw material of 400 provided here and minus opening stock of 100 here. So we have 1800 as material purchases. Then he is asking for the price variance of material P. Formula of the price variance says budgeted price minus actual price into actual kgs used. We have a budget of 25,500 in total. Divided by 1500, we will calculate budgeted price per kg. It is $17. Then it is divided by actual 25,839 divided by 1566. It is 16.5. 17 minus 16.5 into actual input 1566. 783 favorable because we actually paid less price in comparison with the budget. Then in the next question, a company uses standard absorption costing. Last month, budgeted production was 8,000 units and standard fixed production overheads cost were $15 per unit. Actual production last month was 8,500 units and the actual fixed overheads cost was $17. What was the total adverse fixed production overhead variance for the last month? He is saying standard is 15. Budgeted production was 8,000. Actual production is 8,500 and actual fixed production overheads are 17. So we can calculate actual fixed overheads is equal to 8,500 multiplied with 17. That what are actual fixed overheads? Actual fixed overheads are 144,500. He is asking total adverse fixed overheads variance or fixed production overheads. So he is not saying fixed production overhead expenditure variance. He is asking for the total one. Whenever we talk about the total one means we need to follow the principles of under or over absorb. We will calculate absorbed overhead is equal to OAR 15 into actual production units 8,500, which is 127,500 less actual overhead 144,500. So there is a variance of 17,000 adverse. This is the total adverse fixed production overhead variance. There is an alternative of this variance, then we have to calculate two variances. One is fixed overheads expenditure variance and the other one is fixed overheads volume variance. Fixed overhead expenditure variance requires budgeted fixed production overhead, which is 8,000 units into $15. We have budgeted fixed production overheads of 120,000 minus actual fixed production overheads of 144,500. So we have 24,000 adverse, 24,500 adverse. Now we will do what? We will solve fixed overheads volume variance as well. Budgeted units are 8,000, but actual units are 8,500 into OAR per unit is 15. So we have answer of 7,500 as favorable. Because we are actually producing more units than the budget, that's why it is favorable with 7,500. So you can calculate the net answer of 24,500 adverse and 7,500 favorable. So the net answer is again 17,000 adverse. Total fixed production overheads can be determined either with the concept of under or over absorb or either with this one. Any question? Next question is, what was the favorable sales volume variance using the marginal costing? Marginal costing requires what? Budgeted sales minus actual sales into budgeted contribution per unit. So to calculate budgeted contribution per unit, we will deduct all the variable cost per unit from the selling price. 50 minus 4 minus 16 minus 10 minus 1. 50 minus 4 minus 16 minus 10 and minus 1. This one, this one and this one. So contribution is 19. Budgeted sales 3,000. Actually we sell more units. Contribution is 19. More units means we have a favorable variance of 9,500. Then we have sales profit volume variance. Selling price is 15, profit is 5. Budgeted sales units are 10,000 minus actual sales units are less than budgeted into budgeted profit is 5. So 200 into 5 means what? 200 into 5 means $1,000 adverse. You sell actually lesser amount of units in comparison with targeted or budgeted. Then a company operates a standard absorption costing system. Standard fixed production overhead rate is $15. It means overhead absorption rate per hour is $15. Requirement is fixed overheads capacity variance. Budgeted hours are 5,000 minus actual hours are 1,500 into OAR is 15. So you have answer of $7,500. You actually worked for more hours in comparison with the budgeted, or you completed the work which needed 5,500 hours within 5,000, That's why it is 7500 favorable. These standard R's are nothing to do with the fixed overhead capacity, but these are used in fixed overhead efficiency. Suppose question says fixed overhead efficiency volume variance, then standard R's are 4800, actual R's are 5500 into same OAR 15. This time you consume 700 more hours in comparison with the standard or budgeted. That's why variance is 10,000 favorable, 10,500 adverse. We should complete our job within 4,800 hours, but we completed within 5,500 hours. That is why we have an adverse variance of 10,500. Direct labor cost data relating to the last month is as follows. Actual hours worked, total labor cost, then we have direct labor rate, efficiency. To the nearest 1,000 hours, what were the standard labor hours for actual production units? Standard labor hours, we are talking about the total labor hours. So we have what? We have labor efficiency because standard hours can be determined with the help of labor efficiency variance. 3,900 into standard hours is the X minus actual hours 28,000 into standard rate per hour. Once again, standard rate per hour is not given, so we will use the rate variance 8,400 adverse is equal to budgeted rate per hour or standard rate per hour, which is missing, minus we can calculate the actual rate per hour by dividing this value with 28,000. It is 4.2 into actual hours paid. We can divide this 8,400 adverse with 28,000. So we have $0.3 adverse. It means our actual rate is $0.3 greater than the budgeted. So our budgeted rate per hour was 4.2 minus 0.3. Because we have adverse rate variance, our standard rate or budgeted rate was 3.9. Now you can divide 3,900 by 3.9. It is 3,900 favorable. 3,900 by 3.9. It is 1,000 favorable hours, which means our total standard hours were lower by 1,000 in comparison with actual. So 28,000 minus 1,000, we have total standard hours of 27,000. So C is the right answer. Any question? Okay. Then, which of the following variances would you find within an absorption costing system? Sales volume within marginal costing system. Sales volume contribution here, fixed overheads capacity here, fixed overheads volume variance here, sales profit volume variance here, and fixed overhead efficiency volume here. Then we have reconciliation. Reconciliation means you are reconciling or calculating the difference between budgeted and actual results or budgeted and actual profit. Budgeted contribution is 43,900 and actual contribution needs to be determined. So you will subtract all the adverse variances and you will add all the favorable variances to get the correct answer. Suppose we have an answer of 43,900 less adverse 3,100 less adverse 1000, add 1986 favorable, then add 22, then subtract 2200 adverse, then subtract 1090 adverse, then add 512 favorable, then 512 adverse, 512 adverse, then 1216 favorable, and finally 465 adverse. So I think you will get the answer of 38,735. This is the actual contribution. You can also verify this figure by addition or multiplying. That first value is adverse minus 3100, then 1000 adverse, it is subtract, 1986 is added, 2200 is subtracted, 1090 is subtracted, 512 is subtracted, 1216 is added, and 465 is subtracted. Same formula will be, now he says that calculate the budgeted profit for the period is this, and what was the actual profit. So the same formula will be used. In 250,000 all the favorables are added and adverse are subtracted. Here he says that if the actual profit for the period is this, what is the budgeted profit? This time approach will be different. This is actual profit. That's why you will deduct the favorable variances and you will add back the adverse variances to get the final answer. In the next question below is the statement of variance for a business include budget and actual value. Budgeted profit is given, missing value is this. So you will follow the same principle up till here. Add adverse and less adverse and add favorable. Similarly, calculate the net answer of these values. Difference between this net answer and this net answer will be the value of this box you can calculate. So these are called what? Reconciliations. It was relevant with the variances. Any question?